Can President Trump axe the Fed and lower interest rates? Hello, members, super savers, and Bond Course fans. I hope you're healthy and well. And happy Easter and Passover to everyone who's been celebrating. So, President Trump fired off one of his famous social media posts on Truth Social in the early morning hours last Thursday. The post contained 3 surprises. First, Trump for once seemed to think that the U.S. can learn something from Europe when he praised the ECB, the European Central Bank, for being close to cutting interest rates for the euro, the common European currency, for a 7th time. Second, he slapped a new nickname on Fed Chairman Jerome Powell, referring to him as Too Late Powell. And third, he seemed to reiterate his call for Powell to be fired when he wrote that Powell's termination cannot come fast enough. This third point about Powell's termination immediately made the headlines, and even more so after President Trump's economic advisor, Kevin Hassett, provided an update Friday after the president renewed his criticism of Federal Reserve Chair Jerome Powell. Asked by a reporter if firing Powell is an option, Hassett said that the president and team will continue to study that matter. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. Why does President Trump seem so keen to get rid of Fed Chairman Jerome Powell? 2. What can President Trump actually do to pressure the Fed to lower rates? And 3. What do we think might be a likely outcome, and what does that mean for you and your money? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Why does President Trump seem so keen to get rid of Fed Chairman Jerome Powell? Now, this is not the first time that President Trump and Fed Chairman Jerome Powell are set on a collision course. And the irony is that it was actually Trump who had elevated Powell to the position of Fed Chairman back in 2017. That said, and as we discussed in this recent video, linked below in the first pinned comment for easy reference, a certain tension is almost expected between any administration and any Fed chairman. Presidents, more often than not, want lower rates to stimulate the economy, while the Fed chairman has the thankless task to take away the punch bowl just as the party gets going, as William McChesney Martin Jr., who was the chairman of the Fed from 1951 to 1970, once famously expressed it. But this time, it seems that Trump feels it's even more urgent to cut rates. Stock markets are down from their highs. International trade looks uncertain after the new tariffs were announced in early April. And even the dollar and the Treasury market have seen more pressure and volatility than in a long time. Many market observers now see a recession for the U.S. economy as more likely than not. As J.P. Morgan, the world's most valuable bank, wrote earlier this week, the probability of a recession remains at 60%. Aggressive tariff policy could push the U.S. and possibly the global economy into recession this year. So, Trump really feels he needs lower rates to stimulate the economy right now before we possibly enter recession and U.S. consumers really start hurting. And the president is not the only politician who feels this way. Democratic Senator Elizabeth Warren, not one of Trump's friends to say it mildly, expressed the same sentiment a few weeks back when she publicly called for faster rate cuts, as we can see from this headline. Move more rapidly. Senator Warren urges Fed Chair Powell to cut interest rates. And this inbuilt tension between politicians of all stripes and the central bank is exactly the reason why the Fed, like nearly all other central banks in major capitalist democracies, was made independent in the first place. Interest rate decisions will often involve trade-offs because an effective fight against inflation may, from time to time, require higher rates now that may slow down the economy temporarily, but maintain price stability in the long run. And this need to do unpopular things to keep inflation down for the future is what has convinced Congress to give the Fed its independence in the Federal Reserve Act. Congress could, of course, change the law, but no bill to alter the Fed's mandate or governance has gone very far. That's because members of Congress, generally recognize that if they or the president were able to directly influence the setting of interest rates, higher inflation would be the likely outcome. Bringing us nicely to the next section of today's video. What can President Trump actually do to pressure the Fed to lower rates? As I just explained, the Fed is independent by law, and the interest rates for our country are set by the Federal Open Market Committee, or FOMC. The president cannot directly instruct or override the FOMC in its decisions. On the financial side, the Fed is also independent because it gets the revenue it needs to maintain its operations from the interest on the bonds it owns and doesn't need to be funded via the government's yearly budget process. Of course, presidents from all parties have often tried to influence the Fed by exerting some public pressure on it, and Trump's posts on Powell that we discussed at the beginning of this video are just the latest example of this. Presidents have also often tried to speak to the Fed chairman privately, hoping to put in a word for their side of the argument, with mixed success over the years, by the way. As a result, the most effective way for president to influence the decision of the Fed is to wait for the opportunity to appoint new members to the board and to the chairmanship. However, new members of the Fed's board or a new Fed chairman don't get appointed every month or even every year. In fact, Trump's next opportunity to make an appointment will only come around in January 2026, when Adriana Kugler's term as a Fed board member, a Fed governor, expires. Now, Trump's recent post doesn't sound like he may just want to wait patiently around until the next regular decision point. And there is a lot of online and media chatter about what he could do and how safe Jerome Powell's position looks. So, let's have a look at the 3 roles that Jerome Powell holds at the Fed and how Trump could try to oust Powell from all or some of them. Powell's first role at the Fed, and the basis for his 2 other roles, is that he is one of the 7 Washington-based members of the Board of Governors of the Fed. Section 10 of the Federal Reserve Act explicitly says that each member shall hold office for a term of 14 years from the expiration of the term of his predecessor, unless sooner removed for cause by the president. This means that once appointed, every board member, every governor, can serve out his or her full 14-year term unless the president has a cause to remove the member earlier. Many legal scholars expect that the Supreme Court, which as so often would probably be the final arbiter in any real fight about this, would interpret this for-cause clause narrowly and require that a board member must be found guilty of serious misconduct or abuse of power before he or she may be removed early, as Bloomberg reports. So it seems more likely than not that the Supreme Court may side with Powell if Trump wanted to remove him early as a board member over a policy disagreement, meaning that in all likelihood, Trump will be stuck with Jerome Powell on the Board of Governors of the Fed until January 2028, by which time his own presidential term will come to an end as well. Bringing us to Powell's second role at the Fed, and this is the one that gives him his outsized influence. He is not just a simple member of the Board of Governors of the Fed. He's the chairman of the Fed. The chairman is designated by the president, by and with the advice and consent of the Senate, to serve as chairman of the board for a term of 4 years, as the Federal Reserve Act states. Legal scholars note that the text does not explicitly mention that the chairman can only be removed for cause, which may open up the possibility that the Supreme Court may allow Trump to terminate Powell's role as chairman, even without a strong reason, before his term as chairman ends in due course in May 2026. However, even in this case, as I explained before, Powell could probably remain as a simple member on the Board of Governors of the Fed, which might not just be a bit awkward, but also potentially allow Powell to remain in his third role at the Fed as chairman of the FOMC that actually sets the rates. Because the chairman of the FOMC is elected independently by the members of the FOMC. They could, in theory, keep Powell chairing this most important committee of the Fed, even if he wasn't the Fed chairman anymore, which may, in the end, not really get Trump to where he wants to be with regards to the Fed and its interest rate decisions. And by the way, there is a somewhat related current precedent for a member of the Fed's Board of Governors to resign from a vice chairman role, but remain on the board as a normal governor. When Michael S. Barr came under severe pressure from Trump over his role as vice chair for supervision at the Fed earlier this year, he voluntarily stepped down from that role, but stayed on the Board of Governors as a simple member or governor, as the Fed's official press release made clear. In a nutshell, the current law gives Powell strong protection in his position as one of the 7 Washington-based members of the Board of Governors of the Fed. But there may be a certain possibility that Trump might be able to demote Powell from chairman of the Fed to a simple member of the Board of Governors. But even in this case, the rate-setting FOMC might re-elect Powell as its chair, which brings us nicely to the next section of this video. What do we think might be a likely outcome, and what does that mean for you and your money? The Wall Street Journal reports that Trump has spoken with Kevin Warsh, a former Fed governor, about potentially firing Powell before his term ends, and possibly selecting Warsh to be his replacement. And according to Fox Business, Warsh seems to have some fans in the financial community, like, for example, Allianz Chief Economic Advisor Mohammed Al-Erian. And who knows, Kevin Warsh might indeed become our next Fed chairman. But the timing of any transition remains a big question. As I mentioned earlier, Powell's term as Fed chairman expires in May 2026 anyway, which is about 1 year from the time of this taping. And it may be worth waiting for that long in order not to destabilize financial markets, which are currently a bit jittery anyway. From this recent Wall Street Journal article, Treasury Secretary Scott Bessent has consistently pushed back against Trump advisors who want to replace Powell, arguing that doing so would provide little benefit relative to the high potential cost. This week, he referred to the Fed's independence on monetary policy as a jewel box that the U.S. should never compromise. And maybe even more surprisingly, it seems that this is also the view of the candidate himself, whom Trump asked to replace Powell. Warsh has advised against firing Powell and has argued that he should let the Fed chair complete his term without interference. Essentially, despite his best efforts and ongoing grumbles about Fed Chair Powell, even those in President Trump's closest circles are advising him to just let Powell ride out his term so as not to cause more disruption in financial markets. It's also interesting to note that this past week's spat between Trump and Powell could also be a simple tit for tat, because this too late Jerome Powell post, it came the day after Powell gave this economic outlook speech at the Economic Club of Chicago, where he basically said that the Fed has been making good progress on unemployment and inflation. According to Powell, the labor market is at or near maximum employment. Inflation has come down a great deal, but is running a bit above their 2% objective. Powell does go on to highlight that a storm may be brewing, though. Looking forward, the new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. Those policies are still evolving, and their effects on the economy remain highly uncertain. The level of the tariff increases announced so far is significantly larger than anticipated. The same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. In other words, what we're seeing between Trump and Powell currently may just be the general struggle that presidents and Fed chairs often have. The former wants to have the power to lower rates, and the latter wants its independence to adjust rates based on the Fed's dual mandate of managing inflation and unemployment goals. That said, these days, even quasi-normal general struggles can get blown out of proportion with aggressive posts and headlines on social media or in the media in general. especially when things are moving so fast and changing almost constantly. In our mind, though, any attempt to not let Powell ride out his full term as chairman might indeed cause significant disruption in financial markets, especially because such a decision would likely drag on for quite some time as it makes its way through the courts. But who knows, right? We can only impact what's in our control, and what we can control is our own emotions and how we manage our money. Try to keep a calm head and remember our 3 diamond nest egg Ds in times like these. The first D is to diversify. Depending on what your portfolio allocation looks like, this could mean buying a basket of treasury, agency, and corporate bonds, investing in the S&P 500 instead of single stocks, or even buying an international bond or equity fund or some alternative investments. The second D is to dollar cost average. That way, you're not trying to time the market and potentially missing out on any potential upticks. As we talked about in this recent video, in the past 95.5 years, about 75% of the time was spent in bear markets, and most of the money was only made during brief but steep market spikes in the other 25% of the time. And the third D is don't panic. I know this is not easy to do, especially with all the stuff that keeps hitting our screens from social media and traditional media. But as I always say, panicking is almost never the right answer in any situation. And as I also always say, stay tuned to this channel for more facts rather than fiction, and only change your financial strategy if you have a fundamental reason or conviction to do so. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about bond investing and building out a bond portfolio while rates are at good levels, then check out this video here on our bond courses. I've linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.